But let's do a quick revisit to the collapse of SVB, what's going on with these regional banks, because a lot of folks are confused. What led to the collapse? Why are we seeing a lot of stress for all of these banks across the board? Any bank has assets and liabilities. And folks, this is oversimplification. I'm talking to regular folks here. We're not writing in economic books. Banks have assets and liabilities. The majority of the bank's assets come from loans. They lend the money out, then they collect the interest, they collect the payments. That's the income, aka the assets of any bank. We have an economic boom, as we've seen, and I say boom sarcastically, of course. It's an artificial boom induced by the Fed's irresponsible, reckless policy of quantitative easing on steroids. But that aside, when we have an economic boom and we have excess cash in these banks, they have to do something with this cash. They have to plan ahead. They have to invest the cash somewhere, somehow. If they cannot extend it for more loans, they have to secure the cash somewhere. And at the time, in 2020-21, interest rates were pretty much zero. Very little interest rates. But a lot of banks decided to park all of this cash in safe assets, quote unquote, such as mortgage-backed securities, such as bonds. And they planned to hold all of these assets all the way till maturity. So they park the cash, a portion of that cash that they have, and they lock it in all the way till maturity. If they buy a 10-year bond, they gotta wait for 10 years. If they buy a mortgage-backed security, they have to hold that all the way till maturity. Now, on the other side, every bank has liabilities. And the liabilities are basically the depositors. When we deposit money in the bank, that's actually liability to them because they have to service. Unless we're taking loans from them, that is a liability. But when interest rates are at zero, as we've been seeing in 2020-21 and throughout the quantitative easing era by the Federal Reserve, there's no problem with this look that you're seeing right now at all. In this case, the bank has some cash, liquid and ready to be deployed, but they have a lot of their cash locked up in mortgage-backed securities or bonds all the way till maturity. Now, the liabilities are pretty much minimal because interest rates are at zero. The depositors are not expecting any return on their deposits because the interest rate by the Federal Reserve is set at zero. What happens if, say, we have inflation, and now the Fed has to combat inflation by raising rates higher, and the Fed raises rates all the way to 4-5%? Now the depositors in this particular bank have a lot of other alternatives. They can invest in treasuries, for example. They can invest in other fixed income instruments that pays them a lot of interest. So now they ask the bank and say, hey, look, interest rates are higher all over the place. We want some return here. Give us some interest. The bank says, okay, I'll give you some interest. Here you go. But remember, the majority of the bank's assets are now locked in all the way till maturity. Okay, so far, no problems. A little bit of stress, but nothing major. What if interest rates move all the way because inflation is sticking? What if rates move all the way to 7%, 8%? Now the depositors, they got a lot of other alternatives. They can park their money at the 1-year treasury or the 6-month bill, for example, and catch a really decent interest rate. So now they demand more from the bank. Give us more or we're taking our money out. Well, the bank has to respond and give them more money. But a reminder, as interest rates, you might have noticed that little pile of cash that is locked in is actually being reduced. Why is it being reduced? Because as rates go higher, the value of any bond you're holding goes down. There's an inverse relationship between bond and yields. When the Fed raises rates and they go higher, bond prices go down. So if you bought a bond back in 2021 and the rate was at zero, now the rate is moving higher, but you already missed that. The value for a bond is decreasing. And now look at what's going on. Interest rates moving all the way to 8% now. The depositors asking for more interest, they're not finding it, so they're taking their cash and leaving the bank. Now the bank has another dilemma. Not only paying the existing depositors more interest, but they have to make up for all of these lost deposits. The problem is they got no cash. The cash that they have is being reduced in value and it is locked in assets that are held all the way till maturity. Now the bank has a cash problem. Where do they get the cash? They can sell the assets they're holding all the way till maturity at a loss, but that is suicidal. So they have to raise some cash somewhere. From the equities market, from lenders, from taking loans against the assets they're holding all the way till maturity. They have to do something. But as rates continue to move higher, as more alternative continue to pop out around them, they lose more depositors and they have to pay them more. At some point, the bank becomes under a lot of stress if they cannot find the cash and the bank blows up. And this is how, in simplification, of course, what happened to SVB. But this is not just limited to Silicon Valley Bank. We'll look at the FDIC data for insured institutions. Right now, look at this. We have never seen this before. Banks are now sitting at enormous losses from all of these assets that they bought back in 2020, 21, maybe before that, because rates were at zero. Fed raises rates, they missed out on that. But the value of these securities they're holding continue to dwindle. Now they're sitting at a massive loss on paper, at least. And oh, by the way, the geniuses, of course, parked a lot of money in real estate in 21, in 2020, during the mania boom, or I should say the bubble, of course. Guess what happens to real estate when the Fed raises rates? Values of real estate go down. For example, if the mortgage rate rises higher, you're going to see less demand on buying these homes because few people can afford it. So the prices will have to go down to meet any prospective buyer. All in all, we have a lot of banks sitting on real estate portfolios that are losing value. Not to mention, of course, the reckless behavior by other banks of lending to crypto and tulip market exchanges. When these crypto valuations go down, a lot of cryptos went bust, they end up holding the bank. And they have a bigger problem now. And therefore, Over the weekend, we saw the feds shutting down a third bank now. So we got Silvergate Bank blowing up last week, along with Silicon Valley Bank. Now we got the third one, Signature Bank. That's gone now. And of course, we're just awaiting. It's a matter of time before we see First Republic Bank blowing up too. What if this event is more contagious than we've thought initially? What if we see major and established institutions also blowing up? What's going on right now in Charles Schwab is absolutely stunning. The stock is crashing like we have never seen before. And of course, Schwab came out today and said everything is fine. We don't know what's going on, why our stock is being dragged along with all of this. So I did the forensics, and as you can see, quarter over quarter, this is according to the last report, their cash position is down about 14%. Their available assets for sale that they can sell right now, liquid, down about 37%. Their deposits, remember when we talk about depositors, if they leave, that's bad. Well, their deposits are down 7.33% quarter over quarter. But their held to maturity securities, quarter over quarter, up almost 80%. Now, this is the latest numbers according to the fourth quarter of 22. If this trend continued all the way till right now, the first quarter of this year, then the numbers got uglier. And maybe Charles Schwab is also on the verge of collapse. That would be an epic disaster. One must wonder now, who's next? Is Wells Fargo going to be next? Citibank? Bank of America? Nobody's feeling safe right now. And it's not just here, folks. Even across the Atlantic, overseas, they're having the same phenomenon, where interest rates, to combat inflation, are raising rates aggressively. This is causing the same problem. Today, we saw shares of Credit Suisse, for example, collapsing. Shares of Commerzbank and Deutsche Bank over in Germany, all collapsing today. This is becoming contagious, folks, not just here, but globally. And I think part of the problem, at least here in the US, is psychological in nature.